Now, we all know the SPY is the most liquid ETF out there for both trading shares and options. So in this video, I'm going to share with you a simple trading strategy with 10 years of results that you'll be able to take with you when you're done watching. My name is Eric, and welcome to this week's edition of Liquid Options, a weekly trading show about trading options. I hope you'll join me every Wednesday night for a new episode right here on YouTube. And if you haven't done so already, be sure to subscribe to the channel and click the little bell for a reminder about next week's episode. The SPY trading strategy is coming right up. So today we are going to talk about a simple SPY trading strategy involving a single moving average and the stochastic indicator, and that's it. And as you can see by the floating P&L of the strategy down here at the bottom, this has been a profitable strategy for the past 10 years. But let me first say that this isn't a complete strategy yet. And I'll explain what I mean in a minute. But first, I want to go over some key points before we get into the technical parts of the strategy. So the first thing to understand that this strategy that's presented here is for educational purposes and is not financial advice. Make sure you do your own due diligence when you're trading in the markets with any strategy. But as far as the strategy goes that we're going to talk about, we're only going to be covering the long only portion of the strategy. And what that means is we're only looking at buy signals, and we're going to save the sell and shorting strategy because it's actually a little bit different, because bull and bear markets actually behave differently. And you should have different strategies for each type of market. They don't all work in the same market, and mainly because in a long market or a bull market, the markets kind of move up a little bit more slowly, more of a take the stairs up, as they say. In a bear market, they take the elevator down. So it's just a different type of market. And so again, we're just going to be looking at the long only part in this video. Now, also, we're only going to be looking at trading the SPY ETF. As we know, it's got the most liquid shares, it's got the most liquid options. But the goal here is to establish the strategy, and then we're going to look to trade options or even leveraged ETFs from the concept or the takeaways from the backtest itself. So, it doesn't mean you can't just simply buy the SPY. You don't have to trade options on this, or you can even look at SSO, which is like a 2 times ETF. That actually backtested really well with this. But again, we're only looking at this strategy on the SPY ETF. The results are going to be different when you look at different stocks or different ETFs. So we're kind of just focused on this ETF. So let's talk a little bit about the strategy. So the current iteration of the strategy is very simple. We're going to use one moving average, one indicator or oscillator, the stochastics, and I'm actually just going to use a trailing stop for exits. Now, obviously with if you want to try to apply this to credit spreads, like put credit spreads, trailing stop probably isn't your best bet, and kind of talk about that in a different video. But for the sake of this, strategy for now, we're looking at these 3 basic things: a moving average, stochastic indicator, and we'll talk about the settings and all that, and the percent stop, trailing stop for exits. And again, I'm going to put all of the settings in the description of this video on YouTube. So if you want to pull the settings, like the moving average and all this stuff, you can go down there and copy it out, and you guys can take that with you, okay? All right, so let's get into the details of the strategy. So first, to keep it simple, we said it was a long only strategy. The first rule of the strategy is we are only going to take a trade if the SPY is trading above the 200-day simple moving average. I know you guys have heard it before. It's very commonly used, and we are going to use it because it actually backtests really, really well. So this sort of maroon looking color, this is the 200-day moving average. I'll zoom out just a little bit, and you can see the 10 years of data, and we'll kind of jump into that in a little bit. But again, we're only going to take the buy signal, or at least the strategy, what it's telling us is that it only took the buy signal when that signal was a close above the 200-day moving average. So again, we're using the 200-day moving average as kind of a bull or bear market indicator. If it's above, we're going to call it a bull market, and if it's below, we're going to call it a bear market, and we're not going to take any long trades with this particular strategy. So if we scroll all the way back, this is 10 years of data, and this is sort of the tail end. This is the end of '08. This is the tail end of the recession downturn. And you can see that the market was trading below the 200-day moving average, and you don't see any of the signals, right? So just what we talked about. I think the very bottom here was March 9th, 2008 here. And the first buy signal wasn't actually issued until a few months later when it got back above the 200 MA. I'll zoom in a little bit. It got back above the 200 MA, and we didn't get our first buy signal till, September. So, this strategy is going to, it's patient. You're not going to catch the bottom because you'd have to give the market some time to prove itself before you want to commit to putting, money to work to the long side. And you can see down here in the very beginning of the strategy, or when the strategy started to trigger signals, we had a few small losing trades that our trail stop pulled us out of. And we'll go through these settings here in a minute. And then, it started to go profitable. And this is something I like about the strategy is when there are no trades or it's kind of questionable, the P&L just kind of flatlines because you're not in the market. That's what that sort of flat section is. So let's zoom out a little bit. If we kind of scroll through the market through the decade, and we can see that once the S&P, we had a little bit of a surge in profit here. The S&P started trading below the 200-day moving average again. And you can see that the P&L sort of flatlined because, again, we want it to be above the 200 to take these long trades. And then as, what I like about the strategy is as the market actually surges, so does the P&L, right? So we're actually participating in a lot of the upside. I haven't done the math on, if you just done buy and hold, but again, we're talking about trading. We're not talking about investing at this point. So again, I'll zoom out. And again, as the market surges, so does the profit. And as the market fails, the profit, you never get out the top or get in at the bottom. And our P&L sort of flat lines. And then we really started getting off to the races in 2012 or so. That's around this section. So as the market surged forward, we had a few dips and we flatlined and we had a nice little surge. And here we are in, first quarter of 2018, kind of teetering on that 200-day now. Again, the first rule is we're using the 200-day moving average as our filter to say, okay, we're only going to take long trades or buy signals, however you want to call it, when we're trading above that. So let's talk about the stochastic, because the stochastic oscillator or indicator, that is what is going to trigger the signals. We're going to look at the stochastic for the buy signals. And again, we're not using it for exiting, we're using it for entry. And basically, the stochastic oscillator, in case you don't know, it's a momentum indicator. And really what it does is it compares the closing price of the stock, or in this case an ETF, to the range of its prices over a certain period of time. We're going to go through the settings here. I'm not going to get super involved in how the stochastic works and the math. I'm sure you guys have come across it. If not, Google it. There's probably a much better video than I can make on how the stochastics work. But it is a pretty decent overbought, oversold type indicator. You can see it kind of oscillates between, 100 and 0. So, we're going to use that for buy signals. So what we're going to do next is we're going to get into the actual indicator. Now, I had this strategy is what it's called. I had it custom programmed to kind of be included so I could see the P&L. So if you're using Thinkorswim, you're not going to have this. I'll try to make this available once I'm kind of done with it. But at this point, you're just going to have to, you can still have the 200-day and the stochastics and all that stuff. But as an actual strategy, I would need to share that. Maybe I can do that in a future date. But I'm going to come in here to the strategy. I'm going to open this up. And you can see that we have the moving average type is simple. It's a 200-day moving average. We'll get back to the minimum K change percent. But basically, with the stochastic, we have a K period of 10 and a slowing period of 3. So I'm going to put these settings in the description like I mentioned, but I wanted you to know these are the settings for the stochastic. I think what this does from the default is it sort of speeds it up a little bit, and the main line of the stochastic is the K line or K period. That's the one we're going to look at. We're going to use overbought and oversold at 60 and 40. So we're not doing like extreme overbought or extreme oversold levels. I may continue to play with this, but I found that 40 and 60 is kind of enough to say, okay, if we're trading above the 200-day moving average and we get oversold below 40, then we can look for a buy signal as long as we stay above that. So one of the things I removed is there's no long exit, there's no long stop. The short parameters of the strategy are turned off. We're only looking at the long entry. So again, real quick, stochastic is 10-3, overbought, oversold is 60-40, and we're using the simple 200-day moving average. Now, what triggers a buy signal is when once you're oversold and then the stochastic moves back up, it's going to trigger a buy signal if you're above the 200 MA. Now, one parameter in here is that the buy signal actually has to be a 5% change in the stochastic. It can't just be like a super minute tick up on the stochastic, and we'll look at those in a second. So that's the parameters that I'm looking at if you want to try to separate these out for your own platform. Okay, so that's basically the settings for the indicator. And oh, I forgot to mention, let me go back in here. We are using a trailing stop of 3%. So again, that's outside of the strategy because I didn't want to use the stop that was in there. So we have a trailing stop of 3%. So once the buy signal is entered with the stochastic, it puts a 3% trail stop on there, and we can see that in the chart. And I'll just kind of zoom in here. You can see that this, let me zoom out a little bit. And we can see it here. So there was a buy signal. So when you zoom out, you lose some of the lines. These are when you're in the trade. So there was a buy signal way back here in looks like May, and basically you were in the trade all the way up to this point, and then you got stopped out because you had a 3% trailing stop. Now we had a little bit of choppiness here, and you can see our P&L went down, but that's, again, you can't get out at the top. So again, the trailing stop is going to be a 3% trailing stop from the stochastic entry point. So that's really it. It's a pretty simple strategy. And if I zoom in here, I have another stochastic that has some of the parameters in here, and you can see that the signals were triggered where this is the overbought of 60, oversold of 40. We got down here, the stochastic got down here, and then it ticked up, and that triggered an entry. The Thinkorswim throws this off a little bit from where it's actually pointing, but you can see the close of this day was the entry point. And then in this particular trade, we got stopped out pretty quick because the market reversed again. And here we got a long entry, and then we got a trailing stop. You can see we didn't lose that much because it actually surged, and then it kind of came back in. And you can see we had the entry again. Again, it's oversold, and it ticks up by 5%, the stochastic, and we're trading above the 200-day moving average, and that triggers a long signal. Now, just a couple days ago from when I made this video, we had another long signal, and I actually bought some SSO. So let's look at SSO, which is a 2 times ETF for the SPY. Now, one thing we need to consider is the entries will be the same because the price action is relatively the same. However, what we're going to want to do for SSO, because the stock moves twice as much, I'm going to increase the trail stop from 3% to 6%. That'll give the ETF a little bit more room here. And we can zoom out. And you can see it's pretty similar, but it's a leverage, so you can get a little bit more leverage and, not as much as buying a call option or something. But again, right now the strategy is just focused on SPY and a little bit of SSO. And I'm going to be working on seeing how we can use this for options. I don't recommend at this point buying a call option. You can see you get stopped out pretty quick. However, selling put spreads might be an option. So that's something I'll be looking into. And I'll try to share that in a future video or an email if you're on the email list. So be sure to check back each Wednesday as I share more strategies and things. And if you have any questions about this, definitely ask your questions in the comment section. I like to hang out in there for the next couple days. So if you have any questions about the strategy, and again, you can get all the details of the indicators in the description as well. So be sure to check that out. And you can actually copy paste that out of the video. So that's all for today's episode of Liquid Options. I hope you enjoyed it, and I'll see you next Wednesday night.